Hey everybody, Boris, speaking Forex. Welcome to the weekly technicals for Jan 21 to Jan 25 for the majors for euro dollar, dollar yen, pound dollar. ECB in the hot seat is really the theme this week as we enter into the third week of the year. The political scuffles still very much in the foreground, the background, and every other round that you can possibly imagine. But the economic outlook and data is certainly going to have an impact as we enter the week. We'll take a look at the calendar in just one second. But as far as the levels go, we've had a little bit of slippage, certainly a lot of slippage in the euro, which came off, really did a fake out move. We'll take a look at the charts. I'll show you. It broke the hearts of every long that was out there because we thought we had the classic breakout above 115. Now, a complete retrace. The only thing that kind of holds it down or holds it at this level is the 113 level, which is the long-term support. There is, however, we'll take a look on the crosses section, a lot of evidence that the euro may not be looking as bad as it appears on the majors. So stay tuned for that video coming up. But for now, I mean, certainly the euro was the weakest performer as it slid right back. Yen caught a bid off of better tone on the Chinese trade negotiations. We took out the 109s, really within striking distance of 110. But that whole 110, 112 area is very long-term core resistance, and I'm dubious it's going to go much beyond the 110, 110.50 as we go forward. And cable did a classic bounce. The 130 was certainly the very big psychological top. The key thing we kept saying is that the market definitely is cable bid. It continues to believe that something good is going to happen on the Brexit front. They were buying every single dip. The turn last week off of the spike low on the fat finger trade, all of that gave you quite a lot of confidence to just simply buy dips in cable this week. That was the great strategy. It continued to go up. But as we came to the end of the week, big reversal off the 130. Now we're just kind of in a no man's land as we're floating, trying to see what the next catalyst is going to be. So looking at the calendar, the interesting thing this week is that economic data really does have a lot of impact. We kick off the week with Monday to you, Sunday to us, the Chinese data, which this time could have really important impact, especially, actually both ways. So the conventional wisdom here is that Chinese data has really slowed down significantly. Market is looking for, I think, actually 6.5. Although this is I've seen survey, the GDP, no, 6.4, that's correct. Market is looking for 6.4 on the survey side against a 6.5 prior. We come in around 6.5, 6.6. That's actually going to be very positive risk. Dollar yen definitely, in my opinion, takes out 110 off of that news, because it would suggest that the Chinese economy is not really falling off a cliff as much as everybody thinks it is. On the other hand, you'll get a confirmation that the fourth quarter really slowed down much more materially than anybody anticipates. It's just not good news because all across the board, we're seeing slowdown in China, which means we're seeing slowdown in Asia, which effectively means we're going to see slowdown everywhere because they're now the marginal demand across the world. So in many ways, this is going to set the tone right off the bat Monday morning. Very important to watch that. Then as the week progresses, we get UK data. UK data, of course, is going to take second hand to whatever is happening on the Brexit front. But what is interesting, and I think is turned to become very, very key tell sign, is that economy is really deteriorating into the end of the year as Brexit essentially froze all business activity and destroyed consumer sentiment. We had horrible retail sales today. Third month out of the last four where retail sales were negative. We're looking at a bearish read on claimant count and on earnings. The question is just how bad it is. But one interesting takeaway from all of this, by the way, in my opinion, is the worse the economic data gets, the better it is politically for the pound, because I think the incredible pressure on the politicians to not do a hard Brexit, as everybody realizes they're just really going to be thrown to the wolves if that happens, is going to force either a delay of Article 50 or a second referendum, or perhaps some kind of a compromise deal with some sort of a timeline on a backstop. Either way, it keeps the game alive, and I think it still keeps cable as a buy to dip story. But the negative data here, in many ways, is not really negative cable. It's actually the worse it is, in some ways, the better it is, because it's much stronger political pressure on the UK politicians. Then we get the zoo survey out of Europe, a little bit of existing sales out of the US. Again, all of that kind of bearish data set, although I'm not so sure zoo is going to be that bearish. It's already expressed a lot of the bearish sentiment. The Japanese central bank, the Bank of Japan, has a policy decision. Here, no changes expected. As a matter of fact, I think the BOJ remains the only G3 central bank that is just full on committed to more expansionary monetary policy. And the reason why, of course, is because the yen has actually gotten stronger, so it's become a big deflationary headache for them, while they're trying to reflate the economy. Global demand is also coming in. All that demands to just keep pumping money out as fast as they can. I really don't anticipate any kind of hawkish rhetoric out of the BOJ. They don't want to see the yen strengthen any more than it already has. They want to see it pushed above the 110 if they possibly can. Then into Thursday, I think the big event economically will be the ECB meeting. Not necessarily because anybody anticipates any kind of a change, but there was just a marked amount of very negative economic data set at the end of the year. As a matter of fact, German economy was almost, came into a near contractionary state in the fourth quarter. So the question is Mario going to acknowledge this? Are they going to essentially suggest that perhaps full quantitative tightening is just not the way to go, and that certainly no rate hike is assumed at this point? It'll be interesting to see. We also have the preliminary. It's actually quite interesting because we have the preliminary PMI data, which is always the latest and the greatest readings that we get off the ground right before this. So the combo of the PMIs, the flash PMIs with the ECB meeting, really creates a very, very important focus on the euro into Thursday. It'll be interesting to see exactly what the ECB says. Then Friday, we finish up with a relatively quiet week with nothing really on the market except IFO, which is really not a big event. More housing data out of the U.S. and durable goods. Durable goods could be an interesting look here because, again, the assumption here is that the U.S. economy may be starting to slow more than the market thinks. All of that starts to weigh on global growth. But overall, it's really China front of the week and ECB end of the week that should be the key tell signs for us, a key catalyst for trade. Now, looking at the charts, this is one ugly chart. I mean, you're talking about 6 out of the last 7 days of declines. I think very few people had expected this kind of a sharp V-shaped rejection. I mean, this 2 weeks ago, this looked like a beautiful near breakout. We took out the 15s, we held the 15s on a closing basis, and yet complete reversal of the move, taking out the lows all the way down the line, taking out the 20 SMA. Now we're trading below the SMA. The only thing that kind of holds hope for the bulls is that this 13 handle is a very, very long-term support area. It could be a support area yet again. But I think the market needs to feel some sort of confidence that actually ECB is not going to tighten. Ironically enough, more hawkish rhetoric from ECB is probably going to be negative because the market is going to assume that's going to just destroy growth. You actually want the ECB to be more dovish, more neutral, to provide a supportive environment for a little bit better growth in the Eurozone. Otherwise, the euro is just really starting to suffer. The other thing that I think people really don't appreciate is that even though Brexit does seem to be a remote possibility, a hard Brexit is as much a catastrophe for euro as it is for the pound. And some of the, I think, in fact, I would say most of the negative aspect of the whatever political catastrophe happened last week actually was expressed in the euro rather than the pound. Because remember, UK is a massive economy. I think it's the second largest economy in the Eurozone. For it to spin out completely, it's going to be a huge decline in demand all across the European theater. So nobody wants that scenario, and Europe probably took a big brunt of that as a kind of a flow out of the whole region's instability. So if we get positive Brexit news, more dovish ECB, all things that you would think ironically would not be that great, would all actually be quite positive for the euro. We need to see some catalyst. Technically right now, this is the hold, but if we start breaking this hold, it gets very ugly, and very quickly we have a test at the 1200, which is the ultimate spike low this year. Pound, classic moves here. We talked about the 130 being the absolute psychological risk. I'm shocked actually that we took the 130 that fast, but we still, we touched it, we came back. Today was a big rejection day, but this is cable. Don't take too much heart from the big rejection days. You can see that cable will do this. It'll do reject, and then it'll spend the 3 or 4 days consolidating, which I think it may. Certainly right now, the true long is above. It has to close above 130. There has to be some kind of a terminal positive event for us to close above 130. Still, though, I think whatever consolidation we have, it still remains to be buy the dip. If nothing else, then you're still above the 20 SMA. It's the tone of the trade still looks positive, and the market certainly continues to have a positive slant towards some kind of a Brexit deal. What kills this, both technically and fundamentally, in my opinion, well, certainly technically, is if we start to take out, if we actually end below if we give up the 20 SMA at this point, that's a first very ugly sign of something bad happening, and I would not want to be in this trade. Anywhere, I would say anywhere below, anywhere in the 2650s, I do not want to be in this trade, especially on a closing base. Maybe intraday it's okay, but on a closing basis, I do not want to be in this trade because that means the market is really losing faith in some kind of a rational solution to this problem. And then dollar yen actually looks the best of all. It really looks nice and strong into the week. Dollar yen tends to be a pretty trending pair. We took out the 20 SMA. We're holding above it. Certainly has scope here to go to 110. What can destroy this is like really, really ugly Chinese data. We'll have to see how the reaction of the market is to that. But remember, even if you have ugly Chinese data, but you have murmurings out of China that they're willing to do some deal on trade negotiation, market may be forward looking. So at this point, the tilt is to the upside. A positive news should really push us through 110. Negative news, as long as we can hold the lows here, which is basically below the 109s, it still preserves the uptrend that we're seeing in place. Wish you guys the best luck, the best trading. Boris Schlossberg, over and out.